It's now time to move over to the fixed income and FX market as we have traders at Axis Bank expecting the fixed income market to continue to trade on a less aggressive bullish note given the sharp decline in yields. Meanwhile, they also expect increased FX supply with demand expected to also remain elevated and continue guiding overall market direction. Emmanuel Orji, Treasury Team Member at Axis Bank, joins me now for more market movements. Emmanuel, thanks a lot for joining us on the show today. The market is really doing a lot of digesting of information at this moment. First and foremost, we have the Q4 bond auction calendar release. We have the inflation data. We also have the revision of the IMF, World Bank annual meetings as well, looking at some of the grid forecasts here. But give us a sense of market direction at this moment from the highlights of Monday up until now.
Hi, David. Thanks for having me. So just talking about system liquidity, liquidity has hovered around 2 trillion for most part of this week, with interbank rates at 24.5%. And this was largely due to the fact that we didn't really see any OMO auctions. So we expect this robust system liquidity to persist for the rest of the week. For the FX market, it has been tricky. Last week we saw that back-to-back appreciation in the FX rates. But however, this week has been the other way around. And this was caused by just a tweet by President Trump late on Friday, reigniting the tensions between US and China trade. And that led to a risk-off sentiment across the global market. We saw a decline in Bitcoin. And locally, we're beginning to see that impacts the Naira as well. We're seeing back-to-back depreciation for the most part of this week. At the start of the week, we're at 14.58, and currently we're at 14.75 to a dollar. So that shows you that pressure that we're beginning to see. We're beginning to see a lot of demand from the FPIs looking to exit the market on the back of that global risk-off sentiment. So the FX market is beginning to receive that brunt, given that our market is now well exposed to the offshore counterparties as well. For the bond side, like you said, it's been back-to-back news. We saw start of the week a bearish sentiment on the back of the increased supply in the Q4 bond calendar. But however, inflation kind of changed the sentiment, where we saw a significant decline in inflation by over 200 basis points, and that led to some sort of a knee-jerk reaction in the market. We started to see bonds trading comfortably around 15 handles, and we expect this to persist in near term.